Welcome back to The Explainer. Look, today we're going to do something a little different. We're going to look at a stock, but we're doing it completely hype-free. Zero exaggeration. Just an objective, fact-based deconstruction of a company called Taekyung Chemical. Now, I know. Chemical companies aren't exactly the most glamorous topic. They can seem a bit dry or even impenetrable. But honestly, that is exactly where the absolute best opportunities tend to hide in plain sight. We're talking about a true hidden champion today, a business that quietly forms the backbone of several massive industries you interact with every single day. So let's get into it. Here is our roadmap for today. First, their main business. Second, the economic moat. Third, crisis and opportunity. Fourth, high-value CO2. And finally, the unexaggerated stock market reality. All right, Section 1, the main business, the invisible essential. To really understand this company's value, we have to grasp what they actually do day to day. And looking at this breakdown, it's pretty clear. A whopping 95% of their revenue comes from carbonic gas. We're talking dry ice and liquid carbon dioxide. The remaining 5% is environmental products, like magnesium hydroxide used for factory emissions. So basically, Taekyung is a pure-play carbon dioxide manufacturer. And they aren't just some small fry either. They hold a massive, incredibly stable 30% market share in South Korea. They are absolutely the undisputed number one.
And the business model itself is brilliant. It's essentially a massive recycling operation. They take waste gas, literally the byproduct that major petrochemical plants just throw away, and they refine it. They turn that waste into the dry ice that e-commerce giants like Coupon use to deliver your groceries. They turn it into the shield gas that is absolutely mandatory for HD Hyundai when they're welding giant ships together. And they refine it into the food-grade CO2 that puts the fizz in your Pepsi or your KOSPI. They're literally taking a waste product and turning it into essential, everyday infrastructure.
Moving on to Section 2, the unsurpassable economic moat. Any truly great business has structural advantages, right? Things that protect it from competitors. I want you to focus on this number, 8,400. That is Taekyung's storage capacity in tons. And you might be wondering, okay, why does that matter? Well, in the gas business, storage is literally everything. If you can't store the gas, it evaporates, it's gone. The industry average for storage capacity among their rivals is only about 3,000 tons. So Taekyung's 8,400-ton capacity completely dwarfs the competition. It creates this massive, highly expensive logistics moat that new entrants simply can't afford to replicate. But the moat is actually even deeper than that. Let's look at their supply chains. Smaller competitors usually rely on just one single petrochemical factory for their raw waste gas. If that one factory goes offline for maintenance, boom, that competitor is out of business for the week. Taekyung, on the other hand, operates on a multi-supplier model. They've locked in long-term contracts with heavyweights like Lotte, LG, and Hanwha. Because they're so diversified, even if one massive plant goes completely offline, Taekyung doesn't miss a beat. They just keep producing. Okay, Section 3, crisis and opportunity, eco-transition. We need to address the elephant in the room. The Korean petrochemical industry is in a slump right now, going through a pretty brutal restructuring. Chinese oversupply has basically forced Korean chemical plants to slash their operation rates. And that means there's way less byproduct waste gas to go around. So here's the question for you. If you're a company that relies 100% on that waste gas, why don't you just go bankrupt when your raw materials suddenly dry up? I mean, it seems perfectly logical, right? A raw material shortage should be a death sentence. Well, it isn't. And the magic words here are price transferring power. See, carbon dioxide is an absolutely essential good, and there are literally no alternatives. You cannot weld a commercial ship without shield gas, you cannot ship frozen ice cream without dry ice, so when raw materials run short and the market gets squeezed, Taekyung doesn't panic. Since they dominate the market, they simply raise the prices of their end products. The e-commerce platforms and the shipbuilders just have to grit their teeth and pay the premium. That pricing power beautifully defends Taekyung's margins, even when raw materials are scarce. And speaking of alternatives, let's just kill a common myth right now. I hear this all the time. Aren't water packs or PCM ice packs going to replace dry ice? No. Let's look at the facts. Water packs sit at 0 degrees Celsius. They're great for refrigerating lettuce, but when they melt, they soak the cardboard boxes and ruin everything. PCM packs can hit minus 21 degrees, sure, but they need massive, super expensive freezers and huge electricity costs to freeze before you can even use them. Dry ice, on the other hand, sits at a bone-chilling minus 78.5 degrees. It doesn't melt into a liquid, it sublimates right into gas, keeping the box perfectly dry. And it's created instantaneously on demand.
they are entirely parallel markets. So no, water packs are absolutely not a threat to Taekyung's e-commerce demand. Which brings us to Section 4, high-value semiconductor CO2. This is where the story pivots from just a stable, boring infrastructure play into a serious growth driver for their return on equity. Basic CO2 manufacturing is, frankly, high school-level chemistry. Step 1, you compress the gas. Step 2, you cool it down to minus 20 degrees Celsius. Boom, you've got liquid CO2. Making dry ice is just expanding that and pressing it into blocks. So if it's that easy, why isn't everyone making a fortune doing it? Well, because the real barrier to entry is what happens next. The true barrier is something called 5N purity. We're talking 99.999% pure CO2. This ultra-pure gas is what they use to blast microscopic dust off of semiconductor wafers, and you definitely cannot use standard industrial gas for this. If there's even a molecular trace of sulfur or moisture left over from the petrochemical plant, you just ruined a $1 million silicon wafer. Taekyung actually possesses the insane distillation and filtration tech required to achieve this purity at a molecular level, and that lets them sell into the ultra-high margin IT materials market, which is a whole different ballgame compared to basic dry ice. And the kicker? They're expanding this exact capacity right now. As Korean petrochemical giants like LG Chem remodel their aging factories to pump out eco-friendly blue hydrogen, they are generating tons of extremely clean CO2 as a byproduct. Taekyung has smartly locked down contracts with these new plants, like the LG Chem Daesan plant. They are plugging directly into the whole eco-transition, securing a massive, pristine source of raw material to fuel this high-margin semiconductor CO2 business. Finally, Section 5, unexaggerated stock market reality. Let's take a very sober, completely hype-free look at how this stock is actually behaving in the market today. Because look, despite this incredible business model, the stock isn't exactly shooting to the moon. Here are the harsh realities. First, Taekyung is grouped into the broader petrochemical sector, and institutional investors are basically sprinting away from that sector right now because of the China-driven slump. The whole neighborhood is on fire, and Taekyung gets burned by association. Second, their ROE has been pretty flat, hovering around 4 to 6%. That's mostly due to high raw material costs and all these recent infrastructure investments. And third, this is a slow, steady backbone business. It's not a flashy AI startup. That slow top-line growth means massive institutional funds looking for explosive short-term gains just kind of ignore it. But please do not let that fool you into thinking this company is fragile. Look at this. Their debt ratio is sitting at an almost ridiculously low 30.9%. On top of that, they have a 400% current ratio. This is the very definition of ironclad, debt-free management. Even when the broader industry is going through a brutal, nasty winter and operation rates are plummeting everywhere, Taekyung isn't bleeding out on bank interest. They've built the financial fortress required to just sit back, weather the storm, and survive. There's also this one fascinating quirk about this stock you've got to understand. In the Korean market, it's known as the sold-out stock paradox. Insiders and long-term asset holders own about 40 to 50% of the entire company. Because half the shares are totally locked up in a vault somewhere, the daily trading volume is extremely low. It's a paradox, right? Because this low volume mechanically locks out the big institutional funds. A massive fund literally cannot buy $2 million worth of this stock without accidentally spiking the price 15% in a single day. And they definitely can't sell it quickly either, so they just have to sit on the sidelines and ignore it. But here's the secret. That low volume is actually a massive advantage for the individual retail investor. Since the institutions are locked out for now, you have the luxury of time. The playbook here is simple but requires strategy. You monitor their quarterly operation rates in the business reports. You track their ability to successfully push product price increases onto their clients. And most importantly, you patiently wait for that new LG Chem plant to come fully online and for those fat, ultra-high semiconductor margins to finally show up on Taekyung's balance sheet. Because when those numbers hit, the volume is going to trigger. And that leads us to the absolutely crucial point here. Once that high-margin semiconductor revenue proves itself in the quarterly earnings, those massive institutional funds won't be able to ignore it anymore. They'll have no choice but to write the reports, force their way in, and bring a tidal wave of volume with them. So I'll leave you with this provocative thought to ponder. When the heavyweights are finally forced to buy into this hidden infrastructure, will you already be holding the shares? Think about it. Thanks for joining me for this explainer, and I'll catch you on the next one.